So let me just pull up my whiteboard here. And I'm going to share my screen. So this is our Financial 15 segment. And if you're just joining us for this segment, what we just got done with was the first 3 quarters of our weekly webinar where we talk about updates on IRA distributions from the slot group. And we talk about the overall markets. And we had a lot of concerns about the markets this week. So we've been seeing volatile markets since early September. And there's some concerns about, has the Fed done enough? Are they doing too much? What's going to happen? Are they going to hold rates? Are they going to raise rates? When are they going to start cutting rates again? What does this mean for the housing markets? What does it mean for consumer spending? And what does it mean for my investments in my financial plan? So you all have heard my 3 pillars of investing discussion before. And if you haven't, we'll put a link to the 3 pillars investing video in the description. But we're going to focus on 2 areas. So the 3 pillars of investments are asset allocation, principal protection, and account segmentation. So we'll talk about principal protection another time again. So we're going to kind of take that out of here. But we're going to focus today on asset allocation and account segmentation. And I specifically want to talk about our investment strategies for this firm. The principal protection is vitally important, and I'm trying to avoid getting into that discussion. But I'm just going to say we're going to talk about that in another segment. But let's talk about some fundamentals here. So first, I want to talk about modern portfolio theory because it's important for you to know how we manage our investment process and how we choose our investments. So first of all, how do we get there? We base this on modern portfolio theory, and I listed here. That was introduced in 1952. Harry Markowitz was the fellow who wrote a research paper about this, and he then won a Nobel Prize. And basically it says for a given amount of risk, you get a certain amount of return. So what are we looking at here? This chart shows returns by percentage. And of course, we have lower returns here, higher returns here, and then we have risk of, and of course, risk is measured in standard deviation. But that's I don't want to get technical. Then lower risk, higher risk. So what modern portfolio theory says that given these circles represent portfolios. So given a certain amount of risk, you get a certain amount of return over time, assuming that the portfolio, investments stay balanced and they stay efficient. So if you're, for example, let's pick a spot and let's say 5%. Now this is kind of where the discussion around short-term interest rates get interesting, but this will say for 5% return, you're taking let's just call it 8%. I'm sorry, I got it the other way around here. I'm at this should be risk, and this should be return. So this, as an example, for a 5% return on your money, you're at about an 8% standard deviation or risk. So without getting too in the weeds here, that can be actually 16% of fluctuation at 8% standard deviation. But that's how that works, right? A certain amount of risk for a certain amount of return. So you develop portfolios given the amount of return you want for the amount of risk that you're willing to take to get that return. So that is modern portfolio theory in a nutshell. This red line represents the idea that, if we have lower risk, lower return here, lower risk and lower return here, you might think, well, the best way to get lower risk and, just handle this certain amount of return would be 100% bonds. And today that's true. But actually with modern portfolio theory, what determines is this efficient frontier. And that's kind of what this red line represents. And this dot plot on the red line is actually an 80-20 portfolio. So 80% bonds, and 20% stock. So what that shows is that actually helps lower risk and increase returns from a 100% bond portfolio. So, or in this example, if I'm just following the same dot, it's the same amount of risk with higher return. So these are the things that we use to evaluate where your portfolios, or how to develop the portfolios along this capital market assumption line. This is called. So if we have a calculation of how much growth that we should receive given that amount of risk, we can lay these portfolios on this line and balance them with that. I hope that makes sense. Now the question is, how do you build these portfolios? Well, we follow strategic asset allocation. So basically there are many different types of portfolio structure theories. Two really popular and most used are strategic and tactical asset allocation. So where are these? These definitions are from Vanguard. Oh, I'm sorry. Now let me tell you what, I didn't read this to you. I had this definition here for you that I found for modern portfolio theory that might sum it up better than what I just told you there. So modern portfolio theory, and this is from Investopedia, is a practical method for selecting investments in order to maximize their overall returns within an acceptable level of risk. So a practical method for selecting investments in order to maximize their overall return within an acceptable level of risk. So yeah, that's a good definition. I just showed you kind of how it's done in a broad idea of this modern portfolio theory, capital market assumptions, and this efficient frontier. So we identify the portfolios again on this line. Now, how do we choose how we allocate those? So strategic asset allocation and tactical asset allocation are different methods to maintain a multi-asset portfolio. Strategic asset allocation involves setting target allocations across various asset classes and rebalancing the multi-asset portfolio regularly to stay close to the assigned allocation through all market conditions. So you don't overweight or underweight positions. We say, okay, we want to have 25% in international companies, given the portfolio. Say this portfolio here has 25%, as an example, 25% of international companies. You maintain that holding through all market conditions and keep it rebalanced. So what does rebalance mean? When 25% goes to 20, or that would be too tight, 30%, we rebalance that and bring it back down to 25%. If it drops down to 20%, we rebalance it and we bring it back up to 25%, because we know with keeping this portfolio balanced over time, it helps moderate the volatility and helps keep us in line with what we want to achieve for the amount of risk that we want to give up for achieving that return. Hope that makes sense. So in contrast, tactical asset allocation In contrast, tactical asset allocation encourages adjustments to a portfolio's asset mix based on short-term market forecast. This approach aims to systematically exploit perceived inefficiencies or temporary imbalances in values among different assets or sub-asset classes. It seeks to take advantage of market trends or economic conditions by actively shifting a portfolio's allocation across or within asset classes. So in this example, you might say, well, hey, we think, as I said before, strategic asset allocation might say 25% international, but tactical allocation might say, hey, we think international companies are going to do better than U.S. companies. We're going to overweight international by taking that up to 35%. So BlackRock famously did that in 2020, coming out of the pandemic, and they cost their investors a lot of money by taking that tactical shift. So sometimes it works, sometimes it doesn't work. What we follow is strategic asset allocation. I have found little evidence that tactical allocation, these trying to figure out the short-term advantages of market conditions, really adds any value, and it does increase risk of the portfolio from what I've seen. So, our clients aren't looking to earn every nickel of growth that they can. If their stated objective is 8%, they're not saying, boy, you better earn 10%. Most of our clients are saying, we want to keep the money we have. We want to make sure we fund our our goals, our needs, and objectives, and we want to make sure we do it without having to stay up at night worrying about it. Frankly, if a person comes in and says, and I've had these folks before, and they say, well, hey, Mark, we did 10% in this portfolio last year. I'd like to know why we didn't do 12. Because my brother, uncle, cousin, friend, whomever did 12% in their investments. They're just not our clients. I take pride in our investment strategy, and it's we've done quite well for our clients over the years, but it's not about just swinging for the fences all the time. So once we understand how we identify where the portfolios should be on this modern portfolio theory, efficient frontier capital market line, and we identify the type of investment we want to do, and that's strategic asset allocation. Now, how do we determine what fits for you? Most people will say, well, that's easy. We're going to give you a risk profile, and that risk profile is going to say, you're willing to give up this amount of risk for this amount of return. And then we're going to choose the portfolio that works for you. Well, that doesn't make sense to me, just basing everything on that risk profile. What we want to do is we want the financial plan, I'm over here, to drive your investment decisions. Your financial plan identifies the funds that you're going to need in different times of your life. That's what should drive the investment decision, and that should tell us what portfolio we're using and when. So these are our current allocations that we have. Let me blow this up. And I made it just as big as I could to fit with that efficient frontier. But you'll see here that we call these segments, and I'll talk about that in a minute. But our segment 1 portfolio has 0% stock, 45% bonds, and 55% cash, which now is money market. So really zero risk, right? And this is, I'll go into segmentation in a second, but then we have our segment 2 portfolio. So our segment 2 portfolio has 22% in stocks, 59% in bonds, and just 1% in cash and 18% in other. Now, these stocks are going to be mostly buffered positions. That means that there's some level of protection on the downside, because these segments are time-based when you're going to need these funds. Then we have our segment 3, and you'll see we increase our stock holding, and that goes back to that. Remember that corner I showed you where you can actually increase returns with while maintaining the same level of risk? The modern portfolio theory shows us, and that efficient frontier shows us, with having some stock exposure. The difference today being that you can get short-term rates of about 5%. So you'll see that in our segment 1 portfolio, there's no need to take that stock exposure. 18 months ago, we had some stock exposure in our segment 1 portfolio, but we don't need to do that right now. We don't really see that until segment 2. And this is typically money that you'll need in 4 to 5 years. So that's years. All right, and then you'll see here in segment 3, stocks, bonds, cash, and other again being these buffered stock positions. But bonds, it gets important here in this segment. So this is where we start using some bond funds. And this is kind of what drove the decision or this discussion for me today, because we've been seeing some losses in the bond funds. So earlier in the year, well, last year, just to recap, and we're going to go a little over time, so I apologize for that. But last year, just to recap, we made a significant change in our investment structure. And as interest rates were rising, we saw a big drop in our bond holdings. So we liquidated our bond holdings and went to cash and short-term treasuries and things like that. Now, you might say, well, Mark, that sounds like tactical investing, and that's what you just said you don't do. And you're right. But it was, and I've rarely done things in my career like that, but it was very, very obvious to me that this was going to continue for some time, and I didn't have the level of comfort to in a bond manager to help fight this risk of decreasing values in my client account. So I did make that that tactical decision, but that doesn't happen very often. It was a good one, but it doesn't happen very often. But we started redeploying bond funds earlier in the year because as interest rates were moderating, and I guess it was about 3 or 4 months ago, as interest rates were moderating, I expected some stability in the bond markets, but that's not what happened, folks. The Fed adjusting interest rates is one thing, but then the market can also adjust interest rates. So what you need to know, though, is that the fluctuation where we're seeing these bond funds, when we're talking about segment 3 portfolios, well, if this is 0 to 3 year money and this is 4 to 6 year money, we don't need these funds for 7 years plus. So we can handle the modulation there. We can handle volatility there, and we still want to be positioned to have some growth in these positions when interest rates normalize. So I wouldn't worry much when you open up your statements, and you should open your statements, and you see fluctuation or losses in your bond funds.